Dr. Arash, we really appreciate the time and attention that you're giving us today about this important deadline that's coming up for any California business owner that has 5 or more employees, whether they're full-time or part-time on payroll. So if the bottom line for everybody to understand is that if they have 4, 5, 6 employees or more, whether they're full-time or part-time, as long as they're on their payroll system and part of their W-2 system, the state's going to consider them an employee. And the business owner is going to have 2 choices. One is either provide a retirement plan like a 401k for his employees, his or her employees, or they can go the self-doer route and go with CalSavers, which is a state mandated program. And it's a Roth IRA that the state has set up. So that way it's a no cost way for the employer, the business owner, to comply with this new rule. The costs are passed on to the employees, not the employer. So the state's smart. They're not going to start a mandate and make people do things and not give them an alternative. So it's important for everybody to know that they have an alternative that the state has set up. They can go and find everything that they need to find at our website, which is shown on the screen here, which is quiverfinancial.com, CalSavers Retirement Resources. And so just real briefly, before we get into the questions and answers and a little more fact finding, is in here is where everybody can find what they will need as far as frequently asked questions, what they need to get started, as well as a few different videos that we've put together that within 15-20 minutes explains what CalSavers is, what the frequently asked questions are, and what the options you as a business owner have. So we've really streamlined this to save you as much time, energy, and effort as possible. So without further ado, let's jump into some of the frequently asked questions that we get from individuals. And before that happens, Dr. Arash, is there anything that you have a specific question on that you want to make sure that we cover and make sure the audience?
First and foremost, I really want to appreciate say thank you guys for spending the time. I know our dentists in this group really are always looking for good information, and I really appreciate both of you, Justin and Colby. Maybe you can take a couple of minutes to just talk about yourself, talk about the company, your experience in this space, and then we can jump into an overview. So yeah, I'll shoot it back to you. Tell us a little bit about yourself, your company, and what you guys do.
Sure, happy to do it. I started in this business back in 1986, and since that time frame on, I've been building a business that is focused on helping business owners and individuals build their retirement. Our tagline is your retirement vision is our mission. And where we're unique in that process, and over the years, Justin and I have really perfected this, is we have looked at the process of retirement and have really tried to encourage people to do what we call optimization. And for us, optimization is making sure that you manage the retirement accounts within the markets. Like I mentioned, I started in 1996. I think I might have said 1986 first, but
yes, you
started, yeah, I aged myself a little bit. So I actually started in 1996. And if you think of what happened in markets, 2000, we had a meltdown with a very mild recession. 2008, we had a meltdown with a very big recession. And in that time frame, we were working primarily with people who were 60 and older, what we call the red zone of retirement. And when you go through bad markets or lost decades, like we had from 2000 to 2010, you start to realize how important it is to optimize every moment that you have in markets. So we design systems that make money whether markets are going up or down. They're long, short strategies. And a handful of years ago, we decided to take that into the 401k space, because one of the weaknesses we saw in the 401k space is that most 401ks give you stocks and bonds. You make money if both of those are going up, but if both of those are going down, like in times of rising interest rates, rising inflation, then you end up losing everywhere within your 401k. So we wanted to design something so people who are 4, 5, 6 years away from retirement could adjust their allocation with our guidance for when we have bad markets like we do now, and you still can achieve your retirement goals, because we saw way too many people retire at the end of 99, early 2000, or the end of 2007, and then run out of money because they took so many losses in the first few years. So at the end of the day, we're retirement investment specialists. We deal with markets, we understand market cycles, and this 401k business is essentially a side shoot, a side vertical of what we've been doing over the years as far as investment management. And now the state of California has helped us by, forcing a lot of people into this space.
That's great. So how does it work usually when you're managing someone's retirement? Are you guys basically making a decision as to where to invest everything? Do you guys usually talk to the client? Is it a collaborative, effort? Tell me a little bit about the details about how you guys go about with your investment strategies.
Yeah, there's a few ways people can engage with us. The primary way is we manage with discretion. So we have a group of clients that we've managed money for many, many years. They're typically retired nurses, doctors, dentists, engineers, and they eventually get to the point where they say, hey, you know more about this than we do. You make the moves. All I really care about is the bottom line.
Right.
So that's the biggest bulk of our business. And it's set up on a structure that we only make money if the clients are making money, which is unique to the way we structure our firm as well. And then another way of entry on the 401k and retirement side is we have a subscription service where we provide allocation guidance. So somebody who may not need us to manage the money because they're pretty, there's a lot of self-doers out there who are very capable of managing their 401k and the allocation, and maybe they just need somebody to bounce ideas off of, or they need ideas. So we have a system that on a quarterly basis, based on the 401k that somebody's in, and based on age bands and what we think are the proper risk metrics, we'll send to people a quarterly update of how they can change their allocation. And that service is a very inexpensive subscription service, and is a good entryway of getting to understand what we do, and then also incorporate it in the 401k without having to pay us a fee.
And usually, so you said that, if they're not making money, you're not making money. How does it work? You take a percentage of what the gains are? How do you usually charge the clients?
Yeah, so depending on, there's regulatory ways that it has to be done. So in certain clients, we do have a performance fee structure, and a vast majority of situations that fit the regulatory area, it's a flat fee. And how we structure it is that if there's ever a time that the accounts have had 2 consecutive quarters or a 6-month period of time where they haven't earned any money, we refund the fee of that period of time. So it's one of those things that we have to retroactively look back and credit back, but it's within the agreement to make sure everybody is on the same page.
And yeah, and we're also not charging a fee when we're sitting in cash as well, only when money's working.
I see.
Yeah.
And do you guys have, what has your performance been over the last, I know everyone's performance has probably been good. The stock market, everything just has gone up, up, up. How have you, performed? How do you assess your performance in comparison to other, companies?
Sure. We run everything in models. We have a pretty sizable client base. So we design models. For instance, we have an equity model that we benchmark against the S&P 500. We have a macro model, which basically is a diversified model that we bench across other benchmarks that are hedge fund type of benchmarks. Essentially, our goal, what we're trying to do year in and year out, is have consistency, because the most important thing about building wealth is compounding and sequence of returns. So our systems are designed to always strive for high single-digit numbers, regardless of where the market's at. We have the ability to go into inverse funds or to short the market, essentially. So in a year like this year, we're actually having much better performance than most other people are having. Where we do our worst, so I'll give you our worst best case scenarios. We do our worst performance typically in the last year of a bull cycle when everything's really euphoric and our systems get a lot of sell signals and we start to become more conservative. And we tend to do our best in the first year of a bear market when nobody's realizing what's going on and we can make up a lot of gain. So this year has been a great year. We're up double digits this year while most people are down. Last year, we ended the year up double digits, but I don't feel that I can't look at any money manager in the year of 2021 and say that if somebody in 2021 had positive gains, that they were all that great, because
everyone had gains.
The tide was rising.
Right.
So, what you hire somebody for is to do the things that you can't do, which is making money in bad markets. So I will say we're very happy that we're seeing that now, because we're taking everything we learned in 08 and everything we've seen in 2000 in those two bear markets. And this bear market's unfolding exactly the same way in the cycles those are. And so we're just applying that. And so now we're benefiting from a little bit of gray hair and wrinkles.
Now, I know we wanted to kind of talk about 401ks. Before we do that, just one last question, just to add value to all our audience who's listening. So in this type of market, obviously, it seems like inflation is, almost we're getting runaway inflation. For sure, interest rates are going to be rising, potentially recession, maybe even depression. What are some, just from your experience, some do's and don'ts in this type of environment?
Yeah. Don't take on too much risk too soon. Don't just assume that if a company is down 75, 80%, that it's a great buy. Bad companies tend to do that and then go bankrupt. Realize that in the last year and a half to 2 years, any company that went public at extremely high valuations. So even if they get cut in half, they're at extremely high valuations. And so this is how $40 stocks become $20 stocks. And you say, gosh, I'm buying it at 20. It was such a great deal. And it becomes a $5 stock. That's the environment we're in. And so you don't want to take on risk too soon. Bear markets unfold always the same way. The only asset that you can really hide in is cash and the US dollar. There's reasons for that I won't bore you with, but in the first phase of a bear market, the US dollar gains most of the strength of any other asset out there. And the last half of a bear market that brings in recession, which we probably will see, then the dollar loses strength and gold and other things like that become your asset. So just realize it'll be probably September before people should probably be thinking about taking on too much risk.
Right. So you don't think we've hit the bottom yet?
Not at all. No. So far, we're June 13th and just Friday and today, we're finally getting some disorderly selling in the market. Up until then, it's been just way too orderly and too organized for it. Markets end with capitulation. People have to just be in fear and say, I'm never coming back to that market ever again for it to end. After the euphoric run up that we've had, that's just the typical way things work.
And for those who are trying to buy real estate right now, is this something that you would recommend? I know it's not maybe this is not what you guys do, but yeah, what are your thoughts on the real estate market?
Hey, residential real estate is going to be anchored by two things: interest rates and employment. If interest rates rise too much further than where they are now, it's going to slow it down. They're probably right at the level that we're at. And employment, if employment stays where it's at and interest rates stay right around this range, then you will continue to see investors go to real estate as a cash alternative. But do realize that if interest rates go too much higher and unemployment starts to get above 5%, those are the types of things that will threaten real estate. And I will have to add that the current geopolitical situation changes real estate significantly, because if you think about it, at least on the high end, if Russian oligarchs, Chinese wealthy people, anybody wealthy in a different country constantly would buy Canadian and US real estate because of rule of law, and they felt that it could never get taken away from them. It was a safety net. Hey, if something goes wrong in my country, I can go live in my house in Newport Beach or wherever it may be. Now with what's going on with Russia and the US changing the rules and just grabbing assets, that changes that scenario. So I do think that there's threats to real estate, but they haven't manifested enough to be a problem. So those would, but interest rates and employment would be the factor there. And so if you are going to go into real estate, definitely do value add and buy as cheap as you can, which is hard right now.
Yeah, a lot of people are not buying on the cash flow it produces, but just hoping the prices will increase and they're going to get appreciation. But it's not.
Yeah.
We're not at a point where I think lots of these are going to appreciate much more from where they're at.
Yeah, I don't know why somebody would buy if you already own 2 or 3 rental houses. I'm not sure why you would add another one to the mix when you can go out and find some pretty decent quality commercial property where you can have business owners that sign up for 5 years and rent built-in increases and personal guarantees and things like that.
Right.
I think those are better routes for somebody who's trying to find real estate money right now, as opposed to single family housing.
So for the practices, a lot of them, they've taken out SBA loans, they've gotten some of the EIDL loans. The purchasing power of that money is going down quite rapidly. I know they're going off a CPI index now. What is it showing inflation to be around 7-8%?
It is, yeah. Right, 8%.
But yeah, I've heard that index that they're using now is very different than the index they were using 10 years ago and 30 years ago. So when you actually look at it, if you calculate it the same way they were traditionally evaluating the index, it would be somewhere around 15 to 20%, not really in the 8%, correct?
Absolutely, yeah. And if you're a business owner, probably a little higher.
So what do you recommend, like with all these loans that people have out right now? Is this time? I mean, if just sitting in the bank account is just losing purchasing power. You recommend they start purchasing stocks. They start shorting some of these companies. How would you allocate those funds? Because a lot of that can't even be used, I think, for investment purposes. And those, I think, have to be used for business related expenses, correct?
Correctly. Yeah, that is correct. Yeah, there's not many options there. You try and find the highest yielding cash alternatives or rate alternatives. One thing we've done for people in that area that is useful is and I do think there will be some good opportunities in the next 3 months to do this for many people, is you build a bond ladder. So right now, with the rate of increase in interest rates, building a tax-free type of bond ladder is a lot easier to do now than it was a couple of years ago. And then when the stock market falls, the bonds related to the companies fall as well. So those are the corporate bonds or high yield bonds. And when we get into these situations, you can build a very good bond portfolio that will kick off enough yield to offset some of that inflation and things like that. So I would say those would be the avenues to go to, because if you try and go with equity-based things, now you're just taking on risk that unless you're a very good manager, or you use technical analysis with stop losses and things like that. But most people are working with clients, not trading their accounts. Right. Yeah. Well, yeah, but a bond portfolio would work, and that's easy to build nowadays.
Yeah, and I invite all our listeners to contact Kobe and Justin and get more information. I know they've offered to provide a free consultation for any new clients, and we really appreciate that. This is not a sponsored event. We're just happy enough to have them here and kind of share the information. I know we're on a time crunch. There's some deadlines that we have to meet by the end of June, correct?
Correct. Yeah. So what we've got now, I'll pull this up for you, is coming. Where do we go here? Coming up here in the end of June is the deadline, first deadline. Now, state of California is probably not going to act super fast. But what the idea is that you get 90 days past this deadline, and somewhere around there, anybody who hasn't registered with CalSavers or done at least the first step is probably going to start getting letters from the state. And what the state says is that there will come a point that they will send you a final formal notice. And when you get that, you've got 90 days to comply. And if you don't comply within that 90 days, they'll charge you $250 for each employee that you have. And then if you go another 90 days beyond that, they'll charge an additional $500. So if somebody was really defiant here, it could get expensive if you have 10, 12, 13 employees or so.
Kobe, is this limited to businesses in California, or is this something that's happening on a national scale?
So it's happened in a couple other states. Illinois is doing something similar. New York is discussing. California is the first to really enact it. It was something that was going to be part of the Build Back Better, the last plan that Biden had out that didn't go through. What was proposed in there is this type of mandate would be a nationwide mandate. So you can see it's in the political nature to make this thing more national, and there are more states doing it.
Okay. So today we're going to go over California deadlines. Our audience is national, but for those who are in California, they can continue to listen. So as you mentioned, again, you can set this up yourself, or you can put the cost into, onto your employees through the CalSavers program specifically. So yeah, go ahead, tell us. I know you have some questions and answers, common questions people have. Let's review those.
Yeah, I mean, Justin, as you've talked with people, I know a lot of people always ask, is the contribution something that is it like a traditional 401k? Can I contribute for my employees? This type of thing. So we'll go through it all. I think really top down, I guess, would be the best way, Justin. So why don't you give them the rundown of what's expected of a business owner, and then I'll give everybody the alternatives.
Yeah, and just in my head, I'm just kind of thinking, like, if we have a plan that is offered free, and we don't have to worry about that, why would we go with the alternative? What are the best, the benefits and drawbacks from obviously not incurring, more costs? Outside of that, are there any other benefits? And maybe you can kind of give us an idea of why one would go with one option over the other, or if it's just cost. Yeah.
Sure. It's time and energy. So when I had to register our firm, I went to the CalSavers website, and I went there with the pure intention of trying to figure out, okay, how does this change my time that it takes me to run my payroll? And right now, with the number of employees that we have and the way I have our payroll set up, I can go in and process payroll in 5, 6, 7 minutes. What I realized when I registered with CalSavers is that now when I do payroll, and then if I use CalSavers as my way to comply with this mandate, I now have to get my payroll integrated in with CalSavers. So I reach out to my payroll. They say, no, we don't have a full integration. You're going to have to do it manually, which means now every time I run my payroll, I then get done. I have to log into CalSavers, pull a report from my payroll, upload it there. And my payroll now goes from a 6-7 minute process to a 20-30 minute process. And I have 6 employees. So I can't imagine what it's going to be for somebody who has 20 employees. And my 6 employees have been with me for years. Like, we have no turnover. So if you're in a business that, you have 5 or 6 people that come and go every 6 or so months, you're going to be registering with CalSavers all the time and adding employees and removing employees. The other problem that I saw as a business owner is I could go in there and spend all that time registering all my employees, because you have to put in their name, their social security number, all their information. And then CalSavers sends them an email. And so if I did all that and all my employees decided to opt out, I just burned all that time and energy for nothing. Now I'm compliant, so it wasn't a total burn. Whereas what I realized, if I take a 401k that creates this and integrates in with my payroll, I can still keep doing my payroll every 6, for 6 minutes long. And then from there, that integration ties into the 401k. 401k sends everything to CalSavers. Everything is compliant. I get a report at the end of the day. I know I'm covered, and I didn't increase the time and energy that it took me to run my payroll. So that's what I learned the most personally as a business owner in going through this experience. And I realized, okay, if the 401k costs either me or my employees, because this is how it works with the 401k, there's about roughly $10. Some 401ks can be as low as $6 a month and others to about $10 a month for each employee that you have. And many of the 401ks say, hey, you can pass that charge on to your employee, or as the business owner, you can eat it. And so I looked at it and I thought to myself, hey, if it costs me $500, $600, $700 a year to have a 401k, that's a great benefit for my employees, and it saves me all that time with my payroll and keeps me compliant with CalSavers. For me, it was a no-brainer. It was worth the $600-700. So the other thing as a business owner that you have to understand is, CalSavers, you're not going to have any of that cost. It's free. But your employee, if they opt into CalSavers, your employee is going to pay a management fee to CalSavers that's about 85 basis points, 0.85, and can go as high as, Justin, is it 0.95?
Yeah.
Yeah. And so what CalSavers has just done is they've taken the cost of it and they've just passed it on to the employee and say, hey, in your 401k, you can have a mutual fund that'll go up or down with the market and we'll charge you just under 1%. So whereas on the 401k side, there's an annual, there's a monthly fee per employee. And then if the employee wants us to manage the portfolio for them, we can do that. And there's a management fee of 50 basis points, 0.50 to do that. So a 401k can save you time, save you everything. If the employee wants professional management, they can get it at half cost. And so those would be really the major differences that I realized as I was doing it for our practice.
And if you have a temporary employee, are you responsible for this? At what point are you responsible for temps, for example?
Yeah, so that's a great question, because if they're a W-2 employee, whether they're a week, a year, a month, they're in the pool. They're considered it like it. So one of the things we thought would be a fix was, you know what? You just stretch out your probationary period, right? Well, when you go log in to CalSavers and you enroll people, it tells you they start the process 30 days after somebody's hired. So CalSavers kind of the state kind of figured that game out and said, no, we're not going to let you just stretch out your probationary period. You have to enroll somebody within 30 days of them being hired.
Now, so if I have a temp that comes here for a day,
yeah,
I would still have to go through the process for someone who's going to be here for a day or two?
I would, well, if you're going to 1099 them, then no, but if they're going to go onto your payroll system and be considered an employee in your payroll, yes. So the answer to that question is, how do you handle the payment of those temps? If they're interns and you're not paying them, or if you're 1099ing them and it's under $500, it's not going to matter. But
if it's a temp and you're W-2ing that temp, because now we have rules and regulations saying specific types of employees are in fact, even temps are employees. So some come for a day or two. So theoretically, we'd have to go through that whole process, even if it's going to be a short-term employee.
Yeah, absolutely. So this is phase 2 or 3 of the state closing all these loopholes. The first was when they basically got rid of the ability for us to have 1099 and made everything much stricter. That was the first closing of the loophole, but there's still people working around that. Now CalSavers really closes that down because it forces everybody to comply with that 1099, not 1099 rule.
Now, if an assistant, let's say, already has a setup through another office, do they have to reset it up again for each new office they go to?
Yes.
So if they're working at 3 different offices, then they should theoretically be setting this up at each office.
Yeah. So if the 3 different offices are 3 different entities,
right?
Different. Yeah. And like different tax ID numbers that are paying them. Yeah. It's that I didn't even think about that. That's a complete mess. And from that, now that I think through my head, because then that employee is going to have to be registered with CalSavers in all 3 of those circumstances. And eventually, the employee can opt out, which would make their life easy later. But just the initial startup and get going would be a little bit of pain in the butt for everybody.
Okay. All right. Yeah. That's all I have for now. Yeah, go ahead.
I'd like to add one thing too. We ran into a situation, another dentist. He's got 6 or 7 employees, and right now he doesn't have anything set up other than for himself, and he only has a traditional Roth setup. So, with that, you can only save or put $7,000, give or take. I mean, if you're older, if you're past a certain age, you can contribute a little bit more. And so you're kind of limited on what you can kind of contribute for yourself, even as the business owner, as an employee of your own business, right? So by setting up a 401k for him, he gets to set aside a lot more money each year that he can save personally versus only what he can do, just what he has already set up. And I think he said it was a Roth, but if it's a traditional IRA, he would only get to write off or deduct $7,000 off of his taxes at the end of the year. 401k, you get to contribute much, much more, as well as get the tax deductions, not only for the employees, but yourself as the business owner who's an employee of the company.
So could you go from one to the other? Let's say if you're switching from, from doing it yourself to CalSavers, how do you transition between the two?
So yeah, that's a good question. So if you start with CalSavers, because I could see where this is going to happen, where people may go to CalSavers and then after a little period of time realize, this isn't working for me. Or if they're sensitive to really maximizing their future investment options, like Justin was just talking about, because this may bring up to somebody where they're like, yeah, I've been meaning to do my own 401k plan, and they do their homework and realize, you know what, CalSavers is a Roth IRA. It has 12 investment choices. At this point in my life, I need something more, because when you do a 401k or a SEP IRA, rather than just saving $5,000 or $6,000 a year, you can save $25,000, $30,000, a much bigger percentage of your income. The other thing that'll happen with some of your members is Roth IRAs and these Roth 401ks, they have income limits. So if your income's over a certain level, a certain threshold, call it $150,000 a year, you may not be eligible for the Roth system that CalSavers offers. So you have to actually call CalSavers, tell them that situation, and then they have to go through a whole process of converting it into a regular traditional IRA. So back to what Justin was saying is that when you look at what people's options are, what you'll find is that when you look at 401ks, and I'll just show you this, like here's a decent visual, is as an employer, you have a few choices, and especially if you're trying to maximize your own personal savings, you really want to make this as a tool for yourself. Well, you can go into the state-run program. Sure, you can put in $6,000 a year. How long are you going to have to put $6,000 a year before you get to a 401k that's worth $1 million or $2 million or $3 million or $4 million, what you really need to retire on? A 401k, you can contribute up to $57,000 depending upon where your income is. And then you have things like SEP IRAs and simple IRAs that have similar or a little bit less contribution. So to your question, how can people go back and forth? Well, if they start with CalSavers and they realize they want something that they can use to optimize their retirement, then they just reach out to us and we'll coach them. And they don't have to hire us. We'll just coach them on there's not that many choices. We'll tell them what the choices are. We'll do some fact finding with some questions about their life and what their needs are. And then we'll direct them in the direction that is best and allows them to save the most. And then, let's say you start with a 401k plan and you find you don't want to pay for it, or your employees aren't contributing and you want to go to CalSavers, no big deal. All these 401k plans are pay as you play. The moment you stop using them, they stop charging you. You can, and whatever money you did have in the 401k, you could roll to CalSavers or you could roll to an IRA. So you can move back and forth with some logistical use.
Okay. That makes sense. Yeah, I imagine a lot of people are going to start with CalSavers, just maybe lack of preparation or just because it's free, and then they're going to want to transition out. I'm assuming we're going to see a lot of that. What are you think so as well, Kobe?
Yeah, I mean, Justin he's had a lot of one-on-one conversations. So, I mean, Justin.
Yeah,
shared what
my only pushback is to what kind of Colby talked about earlier, is that once they got into it and started figuring out how much time they or the person who handles their payroll was going to be giving towards it, is where now they're calling us saying, hey, that's too much. What do we got to do to get this other plan set up?
Yeah. Yeah, especially if it doesn't integrate with their payroll system. It's just going to be very challenging.
Yeah, that's the hardest part. If you can get full integration, it makes your life real easy, even partial integration. But what I've learned with a lot of these, and that's what we're finding with people, is they first tell us, you know what, I'm gonna just kind of go with CalSavers or go with what my payroll provider offers. And then we're getting back questions from there saying, okay, I got this stuff, but now I'm not really sure if it's the right investment options for me. What do I do? How do I invest in this market? Where do I put it? So and CalSavers or even their payroll department, those are not the people you go ask, hey, how do I invest when inflation is
right.
So we hope
especially in California, they don't know how to manage their own budget, let alone ours.
Yeah,
and
or even the taxes.
One other thing is too, is we also have partnered up with a couple of good payroll providers that have full 360 integration with the platform that we use. And what's also beneficial to that is in most cases, they've been able to actually save you, the employer, money on your payroll side of things.
Oh, nice.
So that's been helpful too. So you're able to not only get some savings there with something that you're doing consistently, but they also have full 360 integration with us and with other companies as well. But
what's the name of the company they use?
Paylocity is one.
Paylocity, okay.
Yeah, they're a really good company. With the clients that we work with right now, I've just shifted over 2 people. They were using Paychex. One was Paychex and the other was ADP. And we just shifted them over to Paylocity, and they've had nothing but great things to say. So, and those are just the recent ones.
Awesome. Very cool. Yeah, I'll check them out. I use ADP. I'm not sure if they integrate or not, but that's the first thing I'm going to check.
Yeah, no, if you come with us, ADP will integrate full 360.
Yeah.
Okay. Great.
ADP, yeah, so the big boys are pretty on top of this stuff. ADP, Paychex, things like that. It's some of those mid-tier payroll providers that, or if you're paying your tax person is also got a bookkeeper in house and they're doing it that way, which a lot of businesses do. That's the stuff that you have to think about, because now does your payroll people start to charge you more?
And I'd add really quick to that. So I know we talked about the monthly fee for the employees being between somewhere in $6 to $12 or $10. The fee to the employer to go through a private plan like us, your basic plan, and this can be for 5 to 1,000 employees, is $100 a month to the employer. So $1,200 a year. And then the other thing that we can put in here too is, for the next 3 years, you'll be able to get a tax credit as the business owner of $500. So that plan actually for the first 3 years is $700 to the employer business owner.
Yeah.
Got it.
Yeah.
So yeah, it's still pretty, it's inexpensive, and you get more options. And, you don't have to go through, like we talked about, kind of that time and energy that you put in with CalSavers. That's what we're here for. When
you factor in the tax benefits that the federal government is giving, and then you also factor in the personal tax benefits that you get as the business owner if you're contributing to your own 401k, your cost of the 401k basically gets washed out when you look at it that way.
Yeah, makes sense.
Yeah, so we're happy to help anybody. Right here on the screen, we've got our phone number, our website we showed a little bit earlier, which is quiverfinancial.com. We've got another gentleman that's not with us now by the name of Patrick Moorhead, and Justin, Patrick, and myself are the 3 main contacts in this arena.
Perfect. So this is the best place to reach you is by email or by phone. They can set up a free consultation. And what should they have prepared for their consultation?
The basic questions are essentially number of employees, approximate payroll amount on a monthly basis, and then are those employees paid weekly, bi-monthly? What's the cadence of payroll?
Okay, perfect. And can you put up your email and phone number just so we can leave it up for people who?
Sure. Phone number is right here, which is the 949-492-6900. And then let's do, I think we have the email here. It's info@quiverfinancial.com. If you go to the website, I think website's just the best place for you land there. And then I would also encourage everybody to, on our website, go down here. And if you really want to stay in touch with what's going on with markets and all these things, sign up for our newsletter, which is our market minutes from the boardroom. And this is something we put out every month. We talk about how diversification should be more focused on correlation. So we talk about 5 asset classes, and we teach you how to have better diversification in your retirement.
Awesome.
Yeah.
Guys, thank you so much. Colby, Justin, really appreciate your time. And we'll go ahead and share a link in the comments section below so that you guys have direct access to the website. And hopefully we'll have the opportunity to have you on again. I'm sure we will want some updates and ongoing feedback on how this crazy market ends up, moving forward this year. I know that this doesn't come around too often for many of us. First time in our lifetime we've seen, a crash, potential depression like this. But I also hear this is a great opportunity that doesn't come across if you are prepared and ready for it.
Yeah, the trick is not to, if you didn't take on too much risk in the last couple of years and you got dry powder, you got cash, these are the opportunities that when you finally buy and you buy right, it's 5 years, 6 years out from here that fortunes are made. You just got to wait till everybody's too scared to step in, and we're getting there. Very
good. Well, thank you again, guys. Appreciate your time, and thank you to all our viewers. Hopefully we're bringing nice, more beneficial content to you on a weekly basis. And again, thanks again, Justin. You guys have a wonderful week.
You as well. Thanks. You too. Thanks, Dr. Rouse. Bye-bye.
Bye-bye.